A charge is a form of security granted by a company over its assets to secure repayment of borrowed funds, typically represented by a debenture. Company law recognizes two principal forms of security: the fixed charge and the floating charge, each providing different levels of protection for lenders and operational flexibility for borrowers. A fixed charge is a legal or equitable mortgage over a specific identifiable asset, such as land, buildings, or specialized equipment. The defining characteristic of a fixed charge is that the company cannot dispose of or otherwise deal with the charged asset without the consent of the charge holder, mortgagee. The charged asset is intended to remain permanently within the business, providing stable and reliable security for the creditor. Consequently, fixed charges offer lenders a high degree of protection because the secured asset cannot be freely sold or transferred without preserving the creditor's security interest. In contrast, a floating charge is an equitable charge over a class of assets, both present and future, that continually changes in the ordinary course of business. Typical examples include stock, raw materials, receivables, and inventory. The leading authority of Yorkshire Wool Combers Association established that a floating charge permits the company to continue using and disposing of the charged assets without obtaining the charge holder's consent while the charge remains floating. This flexibility allows normal business operations to continue while simultaneously providing security for lenders. The floating charge possesses three essential characteristics. It applies to a class of assets rather than individually identified property. The composition of that class changes over time, and the company retains freedom to deal with those assets in the ordinary course of business. These features distinguish floating charges from fixed charges and explain their widespread use in corporate borrowing arrangements involving circulating assets. The principal advantage of a floating charge is the commercial flexibility it provides. The company may freely trade using the charged assets and may grant security over a broader range of property than would be possible under a fixed charge. However, from the lender's perspective, floating charges are inherently less secure because the value of the underlying assets remains uncertain until crystallization occurs. Crystallization converts the floating charge into a fixed charge when specified events occur, including liquidation, cessation of business, or contractual events such as failure to maintain stock levels or inability to pay debts. At that point, the company loses the ability to deal freely with the charged assets. Priority rules also favor fixed charges. Where competing security interests exist, fixed charges rank ahead of floating charges, while earlier charges generally take priority over later charges. Registrable charges must be registered within 21 days of creation. Otherwise, they become void against the liquidator and the secured debt becomes immediately repayable. Registration therefore protects both creditors and third parties by ensuring transparency regarding corporate security interests. Distributions. A distribution, most commonly in the form of a dividend, represents the transfer of company profits to shareholders. The Companies Act 2006 restricts distributions to protect creditors by preventing companies from returning capital that should remain available to satisfy liabilities. Accordingly, a company may only make distributions out of distributable profits, ensuring that shareholder returns are financed from genuine accumulated earnings rather than capital contributions. Under Section 830 CA-06, distributable profits consist of accumulated realized profits less accumulated realized losses. Both trading and capital profits may qualify provided they have been realized, whereas unrealized gains arising from asset revaluations cannot be distributed. Similarly, accumulated losses from previous years must be deducted before profits become distributable. This cumulative approach prevents companies from distributing profits in one year while ignoring historical losses. Certain reserves remain undistributable, including the share premium account, capital redemption reserve, unrealized revaluation reserves, and any reserves that legislation specifically prohibits from distribution. Public companies face an additional safeguard requiring that net assets must not fall below the total of called-up share capital and undistributable reserves following payment of a dividend. Directors must therefore rely upon the latest audited accounts when determining whether sufficient distributable profits exist. Where an unlawful dividend is paid, directors may become personally liable to compensate the company for resulting losses. Shareholders who knew, or reasonably should have known, that the dividend was unlawful may be required to repay the amount received. Auditors may also incur liability where unlawful distributions result from reliance upon erroneous financial statements. These provisions reinforce the principle of capital maintenance and creditor protection. Loan capital v. share capital. The distinction between loan capital and share capital reflects the fundamental difference between creditor finance and equity finance. Loan capital arises through borrowing, typically evidenced by debentures, under which investors become creditors of the company. Share capital, by contrast, represents ownership interests held by shareholders who collectively own the company. Loan capital holders possess no voting rights because they are creditors rather than members. They enjoy a contractual right to interest, payable regardless of whether the company generates profits. Upon liquidation, loan capital holders receive priority repayment ahead of shareholders, substantially reducing investment risk. Furthermore, loan capital is not subject to capital maintenance rules, allowing greater flexibility in repayment and refinancing. Shareholders, however, are owners of the company and generally possess voting rights depending upon their class of shares. Their return takes the form of dividends, which depend upon the existence of distributable profits and are not contractually guaranteed. In liquidation, shareholders rank after all creditors but may participate in any residual surplus assets once liabilities have been discharged.